As to what got us here, I'd say we've had many cycles like this over the centuries if one goes back and studies financial history. There are times when some asset class goes up. In this time it was houses. And so lending increases. People borrow more money. The asset goes up more. People borrow more money. Institutions lend more money. Somewhere along the way, that stops. It's happened any number of times in the last 20 years in housing, but if you go back over many years, all the way to the 1600s, it happened with tulip bulbs in the Netherlands. So cycles of this type of behavior occur. The financial institutions were clearly a part of it. They were lending money to people that shouldn't have been receiving the loans. They couldn't really afford to have them. So there were a lot of risks taken, but they weren't the only culprit. There were people taking loans that shouldn't have been taking the loans. So you've got both sides of that equation. Where this takes us, this crisis takes us, is any number of changes. One is there will be more regulation of how the processes work, who will get what money, how, in particular, how much leverage can there be, both of the financial institutions and for individuals. There will be a lot more tighter credit, tighter controls on individuals and their borrowing. There'll be a number of other changes, particularly over the next few years. Government involvement will be extensive because of the ownership positions. But once the government unwinds its ownership positions of financial institutions, there still will be an extremely active regulatory regime, and much of that will look different than it has for a number of years. Certain types of regulations could have. So for example, regulation that would have said banks or investment banks can't have more leverage than a certain number, a certain level. That would have actually prevented the extreme nature of this crisis. There were institutions that had very high leverage, and once they had rather small losses in their total asset base, it wiped out the book value of the company. They had no capital, and they were out of business. So leverage would have helped, and indeed, I hope that will be one form of new regulation. There are a lot of other types of regulations that may or may not catch the problems. So there's a whole nother category of fraud where someone committed a crime and a fraud, whether that's Madoff or whether that was some of the mortgage originating businesses that didn't do the paperwork properly. There were already laws in place against those forms of behavior. There was already regulation, but people broke the law. So there's always a problem in creating laws or regulations to prevent crime or fraud. And time has proven you never catch all fraud. But so set that aside, you won't catch that or all of it. Hopefully you'll catch as much of it as possible. But as to the companies taking too much risk, yes, indeed, regulation ought to be helpful there in reducing risk in the system and making it so that next time there's a downturn, it won't have as many severe implications. I think certainly a number of American institutions and American regulatory regimes had faults. Again, too much risk, too much leverage, compensation plans that were not properly connected to the risk being taken. Having said that, there are risks and dilemmas all around the world. Germany, for example, had issues as related to Eastern Germany and Eastern Europe and risks in those markets. The UK has had to nationalize a number of its banks, in part because of US risks taken on the balance sheet, but also in part for decisions made that were very much particular to their markets. So I think one always looks for, was there a straw that broke the camel's back or that precipitated all of this? Clearly subprime was of an order of magnitude that it triggered any number of the dominoes, following a different analogy of dominoes. That was a beginning point, but there was a lot of risk in the system around the world and different types of risk, not just an American-made risk profile. I do. I think in the end, if we are in a global economy, there are resources which are both natural resources and people type of resources in developing markets that are important to the overall economy of the world working effectively, stabilizing them. Many of those economies don't have the financial means to support themselves yet. They're not well enough developed. And so it will take outside country involvements, or whether it be IMF, World Bank, or other forms, it'll take some number of forms to provide a safety net, if you will, to get them through a difficult period and then on beyond to hopefully continued advancement and development. I think so far, actually, there's been quite a lot of coordination amongst regulators and regulatory regimes in markets. There's a lot of communication, certainly, and we've seen it in a number of companies when there were crises of a large order of magnitude. Regulators and governmental agencies have been actively communicating. Many of the problems relate to a company located in one country or another, and that becomes that country's near-term dilemma. And so coordination is one of communication and hopefully consistency as to the major themes. And different countries, of course, will have different practices. There's no question, no one country can cure this dilemma or cure the problems, or for that matter, even as we move to new regulation. Again, let's assume that when the world gets better and the economies are improving, active coordination and communication across governments and countries will be critical. We are dependent on one another. There's no breaking that aspect of our economy, of any one country's economy, dependency on others.